Got a new little countdown timer here. Show starting in 3 minutes, so thanks everybody for showing up. We'll see how it goes. I'm not actually sure. Sunday streams, I've only done one, I think, on Sunday. And honestly, I can't remember how many people showed up, but I believe I will be competing against, Sunday church, some people, family days, football, I don't know, whatever, sports. Well, not football, but yeah, we'll be competing against some other things that people might want to do on Sundays, but you can always catch the rebroadcast. So we didn't quite finish yesterday's stream. We were talking about AMC, and obviously there's a lot to talk about with AMC. So we went over what I consider some of the worst trades to take, and it went pretty long, so we divided it, cut it off, did the Q&A, and now today we'll finish it off. I'll get into all my favorite option trades to do on not only these types of stocks like AMC, GameStop, but also what we're going to talk about. It definitely applies to all of option trading. These are strategies that I think you want to become very familiar with. You want to try your best to understand the risk-reward ratio, how they function. Doesn't mean you have to always trade just these 3 or 4 that I'm going to talk about, but I would say you'd probably want to bump those ones up to the top of the list. Anytime you look at something, you see the price action, you want to participate, I would say start with these ones on your list, and if they're not suitable, which sometimes they will not be, then of course you can move over to other things. But I think just as a baseline, and certainly for people early on in their options trading career, I certainly believe that, as I will get into, there's certain reasons why I think these ones are appropriate for most people. But yeah, we'll just let a few people come in. I'm vaccinated. That's some good news. I actually, I'm fairly indifferent to the vaccination. I understand obviously the value of vaccinations, but I'm more of a natural healer. I don't really even take Tylenol. So I'm always, if I can at all avoid something, then I will probably skip it. But vaccinations, they say they're pretty important. And as a person who travels a lot, I suspect we might actually need vaccinations, or certainly get some type of priority ranking with vaccinations. So I'm just going to go ahead and do it. And fortunately, Canada, even though I'm not a resident here, I'm just kind of passing through, they were able to give me my vaccination. So yeah, kind of feels like I got punched in the arm, but other than that, no side effects to report. So I'm just going to jump into my little intro here, just 1 minute of housekeeping while everybody's coming in, making their coffee, and then we will get started. So the rundown basically today, like I talked about, in yesterday's stream, we went through a pretty extensive list of all the worst trades. So you can check back for that live stream. It's up on the YouTube channel now. You can always watch the rebroadcast. I think we had, at the peak, we almost hit 300 people watching. I think it was 297 at the peak. But there's been, 3,000 people who have watched the rebroadcast. So apparently there's some interest in this AMC option trading stuff. So you can check that one out. Today we're going to get into, in my opinion, like I said, 3 of the better ones. And I'll give you one idea that I know some people like to trade, but I will give some warnings on how that trade might go badly. So we'll save that one for later. And then, of course, everybody's favorite, the Q&A. I'll get to as many questions as possible. Can't get to them all. There's always way more than I can get to, but I'll stick around for 30 minutes, 45 minutes, and we'll answer some questions. So bear with me. We'll start in 1 minute. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian, and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so thank you everybody for giving me a little bit of time on your Sundays. I know Sundays are precious to a lot of people, a lot of good stuff to do, so thank you for everybody who is hanging out with us here. So what we're going to be talking about, let me just show the AMC price action here. The reason these types of conversations that we're having about the best trades, the worst trades, the reason they're so valuable in times like this, and especially with stuff like AMC, is obviously, as you can see, this thing has increased in value quite a bit. So at the start of the year, it was below $2, and it hit as high as 72. The up and down movements of AMC is the reason that we want to have these conversations. When you're talking about pretty much everything else in the market that moves at a normal pace, and obviously everything can go up or down at any moment, but when you're dealing with something like AMC, the up and down movements can be so extreme that a lot of times people get themselves into trouble that they didn't really know ahead of time could even happen to them. The implied volatility is through the roof. It can change wildly. It's 260% right now. You can see down here, this turquoise is the implied volatility. It's still very high. It's supposed to be about 50 or 60 long-term average. AMC, 2-3 years ago was about that range. Right now it's at 260%. It has peaked as high as 600. So it's actually very important to structure your trades correctly. That's why I'm kind of harping on these points so much, is we have to understand that AMC could do absolutely anything right now. Anybody who thinks that they kind of know what's going to happen and they can predict this thing, anytime people tell themselves it couldn't do this or it's not going to get to that price, I don't ever like to say, you're wrong, but anything can happen, and we have to keep that in mind. AMC could definitely go to 150 or 200. That could totally happen. It could also crash back down to this level at around $10. It could even go lower if people start to really hate on this thing. Implied volatility could go to 600 again. It really could. Probably not. Even if we got another spike, it might even top out at 500. But if AMC goes to 150, we should expect implied volatility could go very high. It could also drop like a rock. It could also go down to these levels here. Wasn't that long ago that it was in the 130s, 140s. So we could lose 100 to 150% of implied volatility in the matter of a week. So it's actually very, very important to structure trades correctly. And so let me just review really quickly what we talked about in the first stream. So the worst options, these are coming from yesterday. Obviously, naked short options. I say this all the time when we're talking about the worst trades. This is by far the worst trade. And I'm not going to go into it in too much detail right now. But the thing that blindsides people about naked short calls, and that's the case for stocks, indexes, commodities, precious metals, whatever, volatility ETPs, UVXY. The reason that UVXY and AMC and these types of things cause people occasionally to not only go completely bankrupt, but end up owing your broker money, it's because they don't see things as a dynamic machine moving forward. They look at it as a static picture, and they think, well, if the price gets to here, I'm going to be fine, right? I can sustain the price if it goes there, and I have a follow-up plan. I can either hedge or I can, roll it out into the future, is a common thing you hear people say. The problem is there's so many things going against you at once that it really ends up being a terrible trade. So price is obviously one thing. It can go, AMC, for example, it could go to 150, and a naked short call is going to completely bankrupt your account. The second thing is implied volatility is working against you as well. Naked short calls are vega negative trades. So if implied volatility shoots through the roof, you're going to be in a lot of trouble there as well. The third thing is your buying power is all over the place. it's very, very dangerous to open trades that can adjust your buying power and your margin requirements that quickly. And then the fourth aspect, of course, is, and it does happen in a crisis, always at the worst possible time this happens, where the brokers actually themselves raise maintenance requirements on you as well. So you're basically, in yesterday's stream, I compared it to a boxer in the ring fighting one guy, thinking that they can take him. And then the price guy starts beating him up. And then the implied volatility guy gets in the ring. Now there's two guys fighting you. And then the third guy gets in the ring, the buying power. Then the fourth guy, the maintenance requirements. And all of this starts piling up, and it ends up being just a ridiculously bad trade that perhaps in the beginning you didn't really see it all coming. But in the end, it actually turns out to compound on itself. You get 4 or 5 different things fighting against you, and there's no possible way to roll anything out because everything is based on cash, buying power, maintenance requirements, and you just can't do it. So avoid those for sure. Long puts aren't necessarily terrible, but the problem with long puts is implied volatility is so sky high that you're paying an insane amount for those premiums up front. And there's a very, very strong headwind against you. And then, of course, as the thing starts to settle down and people start to lose interest in AMC, maybe if it goes down to 20, we would expect implied volatility to decline a little bit, and that's going to really hurt that trade as well. So that blindsides people. And then the third one is the short put options, where the reason you want to be careful here, again, implied volatility can move so quickly on people that even though you think it's never going to get to your way out of the money strike price, the implied volatility itself could really cost you. And then the second thing, of course, is on something like AMC. We're talking about something that if you sell a way out of the money put option, it could go well below that. Sometimes when people sell put options, they're thinking that they can take assignment to the shares. But the problem is if it gets too far below your strike, when you turn around and sell those covered calls to try to reduce your cost basis and collect that premium, it's so far out of the money that you're getting pennies for those covered calls. And it's never going to be able to whittle away at your cost basis. So that's a huge problem with these really bad trades. So what I want to talk about now is 3 trades that, in my opinion, are what people should be focusing on. And what we're really going to be harping on today is the concept of only sticking to defined risk option spreads. There's several reasons why we want to do this, especially on something like AMC. Remember, it can go to 200, it can go to 10. Implied volatility could go to 600, it could go back to 100. Everything is on the table right now with AMC. So you definitely want to stick to these types of trades. First reason, they are maximum loss, or they are capped maximum loss. So as far as risk management goes, you're never going to get yourself into too much trouble because you can already see when you open the trade what the maximum you can lose is. You're not going to get blindsided by your buying power changing, by your maintenance requirements, by the thing moving, IV spiking on you. That's never going to happen. You know ahead of time. And so risk management is much easier. The second point here, because they are using both long and short options, we don't really have to worry as much about the implied volatility. Like I said with the long put option, for example, or long call options, same thing. You're paying an awful lot of premium up front for those positions because of volatility. But when you're selling one and buying another within the same trade structure, you actually reduce that implied volatility impact. It's not totally gone. There's still a little bit of difference in the vega between the strikes, but as long as you keep your strikes within reason, then you can largely reduce that impact. And then the last thing here, again, this is a highly overlooked aspect of option trading. People really get blindsided by this in particular, is you really want trades that don't really impact the rest of your portfolio if they start to go dramatically against you. That's the problem with selling naked calls, of course, too, is that people say, well, I'll roll it. Roll it with what? You're out of money, you're out of buying power, you're way negative, and the rest of your account is in serious trouble to the point where you might have to either sell the contracts at the worst possible time or liquidate some of the other positions in your account to try to finance this and see how long you can go with it. Or, I don't know, take a second mortgage on your house and quickly deposit the money, whatever you do. But with these types of defined risk option spreads, we're never actually going to get into a position where the health of our account itself is going to be put in too much jeopardy. So that's a good thing with these trades. So let's start with the first one that probably everybody knows what I'm going to say. This is a good baseline strategy for anybody, not only new traders, but just people who want to simplify the process. That is the vertical spread, the trusty vertical. These are trades that everybody needs to have in their option trading toolbox. So, vertical spreads are essentially buying and selling at certain strike prices to take a market bias one way or another. And you're essentially drawing a line somewhere. I'll get into where the lines can be drawn, but you're basically drawing a line, and above or below that is where your profits are going to be made. So let's take the first example of a person right now. This is AMC. Let's say the person thinks it's going to go lower. They think it's going to go down somewhere around here, maybe below 20. So we're going to build ourselves. I'm going to use the exact same contracts or the expiration that I used for yesterday's 3. I'm going to use that again. So that's this July. Let's just build a standard long put long put vertical. And then I'm going to change this to 20. We're going to see what this looks like. Why is this such a good trade? Well, this is what it looks like. So today's price right there, of course it's Sunday, so it's not moving around. The vertical spread is buying. You can see we're buying the 25 and we're selling the 20. So again, this is a defined risk option. We know right ahead we cannot lose more than the money we put up. In this case, $114 per contract. Secondly, we are both buying and selling premium, so we don't have to worry about implied volatility that much. It will go up and down day to day. This is this trade has Vega in it, but it's not going to be catastrophic in any way. And then the third thing is, it doesn't matter how badly this trade goes against us, even if AMC goes to 1,000, the rest of the buying power, the health of the account, is not ever going to be threatened by that. We're just going to, we know ahead of time we can build this, and we can start making predictions on what's going to happen. So this is a great trade. Right here is the break even. So if somebody thinks it's going to go below 2380, which it's not that unreasonable. 2380 is about right here. So if it just in the next few weeks just dips below this level of this most recent spike up, this is actually a very good trade. You're risking 114 to potentially make 386. That's a very good risk-reward ratio, and we can get this because AMC is such a crazy, nutty stock right now that we can do this so far out of the money, and we can still actually build a really good bearish trade here, but we don't actually have to do something silly to get bearish, like selling a naked call or even selling way out of the money puts by themselves, like selling the 20, for example. This trade. This is much more dangerous, obviously, because if it does go down to 10, those covered calls are going to be worthless. So we're never going to be able to whittle away our cost basis with that trade. But this one here, this is a very good trade. We're just looking to make our profit there. The other thing, unclick this, is what if you think it's going to go way up? Actually, you know what? I'm just going to do a little change here. One thing that I want to draw attention to, yeah, I should do that right now. A lot of people think, and this is a very common thing you hear, is that what I just showed you was a long put vertical. There is also a short call vertical that is materially the same trade. It's the same market bias. A lot of people think that the short call vertical is short volatility trading and the long put vertical is long volatility trading. So oftentimes when I say you're supposed to take a long put vertical if you're bearish on the stock, if you think AMC is going to go down, inevitably someone's going to jump in and say, well, don't take a long vol trade. That's the losing side of the trade, right? As Tasty Trade will teach you, and a lot of people will mention, being on the short vol side of things is the higher probability side. So they'll inevitably say, well, of course you should sell the call vertical instead. It's a much better trade. What I wanted to point out is that those trades are materially identical. I mean, mathematically, they are basically the same thing. So we will go to one video that I actually made in the past that goes through that in detail. If you go to my YouTube channel and type in vertical, you can probably find it pretty quick. There's some simple vertical stuff there. This one right here that says long put verticals versus short call verticals, this will explain what I'm talking about. But really quickly for everybody here, because I know it's going to come up later on, anytime I talk about verticals, somebody's going to say it. I'm going to use an example of VXX, and I'm going to show you why it's the same trade. So first of all, we're picking the strike, same thing. Let's say the long put vertical person wants to buy this one, a 30.25. Okay, there's that trade right there. So I'm going to adjust this. There's the break even right there. So again, bearish trade, VXX goes down, we make our money. There's the break even. We're risking 218 to make 282. The reason people think short call verticals are short vol is because they're not using the same strikes. They're using something like a 30 to 35, right? So if you sell this one, a lot of times people will say, well, this is the opposite side of the trade, right? What we know about these are, again, we make our money if it goes down, but they think this is the better trade because it's out of the money and it's short. Well, technically, all you've done is you've moved the trade over, so now you're risking the loss of 384 to make a gain of 116. This is not at all the same risk-reward profile as this one. This one is clearly better, right? But what you'll notice about this one, all we have to do, if we adjust these to the same strikes to represent the exact same trade and same market bias, look what happened. This is now a short call vertical where people would think that this is a short vol trade. It's not. It's the same thing. The break even's the same point. You're risking 220 to make 280. That's the same trade as this one. These are materially identical. I mean, basically within pennies, you can see here 218. It's 2 cents off. And that's obviously just due to bid-ask prices and differences in that. But you have to understand the options market is very efficient. And long put verticals and short call verticals, when you adjust them for the same risk-reward profile, they are the same trade. So we've got this long put vertical, the Vega, long Vega over here. It passes the break-even point, and then it gets neutral right about 26.50. It's the exact same thing on the short side. This is a long Vega trade over here. It passes the break-even, and at 26.49, it gets neutral Vega. They're materially identical. So that's just a little side spiel here, just because it's so common. And like I said, I know once I open this up to the Q&A later on, I guarantee people are going to be saying, well, long put verticals are a bad trade. You should definitely do the short call vertical because the smart money is the short vol guys. The bad trade is the long vol. They're the same trade, guys. They're exactly the same. If you structure the risk reward the same, materially identical. And in fact, the reason why I always recommend the long put vertical or the long call vertical as opposed to the absolute mathematical equivalence, if you notice one other thing about those two trades, just go back to it really quick. This is a side tangent, but I think people will be interested. Where's the short strike on this long put vertical? It's the 25. Short 25 put. That's when one of our strikes becomes in the money. What about the short call vertical? The short strike is a 25 call. That is not the same thing as a 25 put. The short 25 call is already well in the money. So, early assignment, and whenever you're selling options, you have to understand that while early assignment is very rare, I can really count on one hand the number of times it's happened to me in the last, I don't know how many years. But you have to be aware that it is a thing, that if your contract is either in the money or if there's a dividend approaching, you have to understand that there is the potential for somebody to exercise something on you. So if you are doing something where your short strikes are in the money, you probably want to make sure that you're checking your trades multiple times a day. And the long put vertical just makes it so, if it's the same trade more or less within a few pennies, then I always default to just tell people, go ahead and do the long put vertical, or what we'll get into now, the long call vertical. And there's a little bit less maintenance and you have to pay a little bit less attention to it. But anyway, getting back, now we're going to go with the person who thinks AMC is going to just rocket to the moon, right? Yesterday there were a lot of comments with rocket ships and, moons and all that stuff. Let's say you're one of those. Well, the long call vertical, again, is a very, very good trade for this situation. And I'll show you why. So AMC, now we're going to say the 75 call, and then we're going to cap it at the 100 put. Or sort of, we're going to sell the 100 there. And this is what this one looks like. So this is for a person who's very bullish on AMC. Again, break even is here. Current price is right here. So if you think AMC is going to the moon, this contract is going to cost $255 up front. Max loss is capped, so it's a defined risk spread. We're both buying and selling a contract, so we don't really have to worry about implied volatility changes. And you can make $2,245 if it goes over 100. So this is a very, very attractive risk-reward profile. Now, obviously, there's a reason for that. The options market's very efficient. So if somebody's willing to pay you a 10-to-1 profit margin, you have to know that I'm not telling you that this is going to happen, but options pricing can also be viewed as probabilities. And when somebody, the market, all the buying and selling and all the real dollar activity out there is telling you that they'll pay you a 10-to-1 risk-reward ratio, they're telling you it's not going to happen. I mean, basically, there's a low probability that that's going to happen. But anyway, if you are a to-the-moon type of person, then there it is. This is a very, very good trade that won't get you into trouble, that doesn't face that massive headwind of implied volatility, and will allow you to make a really nice profit if you're right. So the obvious tangent to go off of here is what about long call options? Again, that's going to be something that people ask me. So let's compare those two right now. Let's do the exact same thing. Compare a long call, which is just a single contract on its own, versus the long call vertical. And the reason why I always say that for most people and most situations, the long call vertical is the better trade. So what are the differences? First of all, the long call vertical has a break even at 77.68 there. The long call has a break even at expiration of 86. That's because you are paying a lot of premium up front to open this contract. It has to go $10 higher just to break even. That's the difference between the long call and the long call vertical. This one is also susceptible to volatility changes. So you have to know what you're doing there as well. As far as the max gain at expiration, remember this one, first of all, I will adjust because the long call, you can see, this one is going to cost you $1,100 to open. That's the minimum. One contract is $11.20. So we're going to have to do a little bit of adjustment. If you're a person who doesn't want to put up $1,100 for a trade, you might just default to the long call vertical just because it's cheaper, and it's still a really, really great trade. But let's do a little adjustment to sort of make these the same and do 4 of these. So now it costs $1,000 per 4 contracts. The max gain is $9,000. Over $100, this trade can make $9,000. What about this one at expiration? At 100, this trade only makes $1,300. That's one of the differences. So if you're right at expiration, this trade is just far better off, right? The break-even price is much lower. The profit is going to be really, really good. The difference comes with the speed of the move. If you think that AMC is going to rocket to the moon next week, then that call option will be more sensitive to those moves. The second component is implied volatility. Because now you're a long call, you don't have that short contract offsetting the implied volatility. So you better be sure that you know which direction implied volatility is going to go. If it skyrockets again, then you're going to make a bunch of money. So I'll show you what that looks like. With the vertical spread, we don't really have... Sorry, am I on screen share? Can't remember if I clicked it. We don't really know for sure. What was I talking about? I lost my train of thought there. So what I'm going to do is a volatility adjustment, because the implied volatility at 260% right now, you can see it on this contract. 260 is very high. Well, if we do a volatility adjustment on the long call, what would we expect this to happen? If AMC did go over 100, it's one of those inverse situations where typically when things go up, implied volatility goes down. It's the exact opposite in things like AMC. When this thing goes up, you can see there's a quite clear correlation between the spikes in implied volatility. That's happening because it's skyrocketing to the moon. So we have to assume that this is reversed, and that if AMC goes up into the hundreds, implied volatility is going to go up. So what we can do is we can do a little adjustment here. So if implied volatility goes up 50, that's what happens. That daily gain loss curve shifted upwards. And now we can actually start making some quick profit. If it happens fast enough, we can start getting that there. The problem is, if it takes too long, then, of course, you're going to be subject to a much worse risk-reward profile at expiration because you paid too much for the contract to open it. So again, the long call vertical does allow you to make that big profit if you're right, but it does require the contract to have a little bit longer duration on it. So that's really the separating factor here. I would say, if you wanted a general rule of thumb, I would say that 90-ish% of the time, long call verticals are the better trade in nearly all situations and nearly all stocks and indexes and underlines. The long call vertical is the better trade. In something like AMC, GameStop, all these others, and I know the comment section is going to be hitting me with, here's one, CLOV, Clove. Yesterday there was a bunch I'd never heard of. I'm not really this type of trader. I don't trade these high momentum stocks. But the problem is the implied volatility can actually spike higher, and it might make a case for the long call being a fairly good trade at this moment. If you're the to the moon crowd, then this might be one of those 10% situations where you kind of, flip a coin. They both have advantages and disadvantages. The vast majority of the time, though, long call verticals is the trade. Don't focus in the future, right? The reason I'm also doing this stream isn't just for AMC now. It's for the future. We're going to see this thing play out many, many times. You probably want to put the verticals in your toolbox, and you probably want to remove long puts and long calls. They're a very difficult trade to make money on. You really do need very quick, very violent moves and increases in implied volatility. And regardless of what you might think this stock is going to do, the reality is that very rarely happens. We very rarely have those perfectly timed violent moves where you happen to have a long call open. I know people are in the comments are going to be telling me that they've made a bunch of money on AMC, and I'm real happy that you have. That's awesome. Good for you. Congrats to everybody who's done that. But you have to understand that the probability of that succeeding going forward isn't very high. That's a tough trade to make money on, long puts and long calls. Verticals, on the other hand, these are trades that you can really do well, and they apply to really anything. So definitely throw that in your options trading toolbox. The second trade, these are I don't know about my personal favorite, but they're very high on the list, butterfly spreads, and especially the broken wing butterfly. So let's talk about these very, very cool trades. First of all, we will build one here. So I'm going to build a bearish one because I don't know, I'm defaulting more. I think more people in the comment section probably think it's going to go down as opposed to going up. But butterflies can be made for any situation, as we'll see in a second. So I'm going to adjust this to 60 and this one to 20. This is what a butterfly option looks like. Very cool. Here's today's price right there. And I'll just use that for later. But this is the structure. Again, getting back to that theme, defined risk option spreads. We know ahead of time the max loss, in this case for one contract, $600. We know the max gain, $1,359 at the peak there. All of this is good profit range in here. This is a good trade that's never going to get anybody in any trouble. And you can profit quite nicely. You can make more than you're risking if you happen to get the price correct. The really cool thing about this trade specifically, first of all, it can be moved around. So if you don't think that the 40 is a good center, you could center it around 30, you could center it around 80. You can also do call butterflies on the high side. You could center it around 80 or 100. But anyway, this can be moved around based on where you think the price is going. But the best part about it is, we'll do both cases. Let's say you're a person who thinks it's going to probably stay where it is, maybe go down a little, but you're actually worried that the Wall Street Bets crowd and this social media momentum might actually keep it very high for a while. In other words, you're more worried about this side than you're worried about this side. What you can do is called the broken wing butterfly. Take this 60 strike and make it 55. You can see what happened to the trade now. It's still defined risk. Both sides is max loss. You can't lose more than that. The middle range, you can still make your $1,250, but now you've transferred the risk from over here and you've put it over here. So now on this side, you can only lose $200. On this side, you can lose 700. And then, of course, in the middle, you can make your 1283 or whatever it is. Again, very, very good trade for somebody who actually has a bias. It might stay higher than I'm worried about it crashing down. If you don't think it's going to get below 25, if you think that this social media thing is going to stay for a few weeks, then this might be the trade for you, because very good risk reward profile, hangs out in this pretty large price range, any from 27 all the way to 53. You're going to be in some type of profit range, and you've shifted the risk over. Let's go back to the original position. Let's say now you're a person who's very bearish. You think AMC, I mean, it couldn't possibly stay high, right? You're not worried at all about the high side. Now we can break the wing on the other side, put this to 25, and we can move some of the risk over here where we just don't think it's going to stay for very long. Remember, this is the price right now. We just think it's going down. And in fact, we can actually just eliminate the low side. What price would eliminate the low side? 28, more or less. We can move that, all the risk, over to this side. If you're the type of person who thinks there's no way it's going any higher than it is, but you're actually kind of worried that this thing could really go, but you still think, yeah, it might stay in this, 25 to 50 range. You'll still make your big profit there. You can make over $1,000. If it goes down to here, you might lose 26 bucks. This is a pretty good trade. The risk, of course, is that if it does surprise you and go the other way, you could lose $800. But again, you'll know that ahead of time. Don't ever risk something that you can't lose, that you know that that's going to really put you in a lot of pain. Don't do that. But at least you know ahead of time that the price isn't going to shock you, the implied volatility is not going to break you, the margin's not going to change. It's going to be a manageable trade. So I actually really, really like butterflies, especially the broken wing versions. And so in my options trading community, I have a strategy that I call directional flies. And this is what we're doing. We're essentially, butterflies are market neutral trades. They work best when they're sort of delta neutral-ish, two sides and then the peak there. But if you do have a slight bias, sometimes it is useful to take a little bit of that risk from one side and put it to the other. And it's a very good way to do that. How often are we actually totally indifferent to price action, right? Usually we have a little gut feeling that I'm a little bit more worried about one of those sides. That's what the broken wing butterflies are really, really good for. So the third one, where's my little list here? The third one is the good old Iron Condor, the short Iron Condor. And I would say it's a personal favorite of mine, probably top 3 option trades. I think they can apply to not only AMC, as we're going to go over, but just a whole bunch of other things. Plus, it's just a very cool sounding name. Just as a little side tangent, if anybody's interested. My business, my brand wasn't always volatility trading strategies. So back in, I believe about 2009, I was VIX trader to start. So maybe 2007, 8 to 2009, I was VIX trader. I was just sharing my performance. Back then I was just a full-time trader. I didn't have a business. I was just sharing my work, sharing my portfolio, writing a little bit. My second website was actually called the ironcondor.com. So that was, I guess, 2008 or something to maybe 2012. That's how I was branded. I thought it was a really cool sounding name, even though at that time only 20% of my portfolio was actually short Iron Condors. I still loved the name, and my friend told me it sounded really cool, so I actually named it that. And then after that, I went to 2012 to 2015. I was called Prosperitas. And then that was back when I was actually managing capital directly. And then in 2015, I became a full-time digital nomad. Can't manage capital directly anymore. Became volatility trading strategies, and that's been about 6 years under that. But way, way back then, every time I see the word Iron Condor, I just get a little nostalgic for the past, because I was actually the ironcondor.com for quite a while. Anyway, what is an Iron Condor? So let's build one. Always good to see the picture in front of you. So let's build an Iron Condor. They always start looking awful, but we're going to adjust this. So let's do the high call strike at, say, 50. And we'll just do $5 wide strikes. And then the low put side, if you notice what's happening here, this is essentially two verticals just put together. So if you look at it down here, this is a long, or it's a short call vertical and then a short put vertical, and they're basically just put on top of each other. But why is this such a good trade? Well, again, here's today's price. Defined risk, so it's not going to get you into trouble. We know what we're going to make and lose. In this case, we could lose 276 and we could make 224. So it's roughly balanced. It's a little bit unequal, but let's just call it a 50-50. You could adjust the strikes and get it to 50-50 or 80-20, whatever you want, you can get that. But the difference here between the butterfly previously, which again, it looks similar, except that peak, right? So butterflies peak out and then they have a diminishing profit range there. Iron Condors basically just flatline the max profit and a little bit more predictable in that sense. So typically when I'm trading, I don't break the wings of my Iron Condors. If I'm trying to do a bias trade, I will do broken wing butterflies and I will transfer the risk to either side. But on Iron Condors, I just like the standard template here. You know exactly this whole big range, anywhere from 22 to 52 is going to be some type of profit. And then of course on the strikes, the short 25, the short 50, max profit from 25 to 50, which is a pretty decent range. And you're giving up, you're risking that much if AMC goes very high or if it does crash down very low. Obviously, this is a trade that you can't get into too much trouble, but what I typically do with my Iron Condors, I still use stop losses and stop gains. So you don't have to do this, but I just like to use them. I use a 50% stop loss, 50% stop gain based on the premium collected. So it says 224 at $1.12. I would basically be using the stop gain. If this 224 goes to $1.12, that's going to be 50% profit, and I'm going to close the trade. The reason I would do that is I don't really want to wait for the full expiration. Sometimes you can... Sorry, I wonder if I should close this window. There's a seaplane airport right behind me. Sometimes you can reach your 50% profit range quite quickly. This is a trade that's contracts is a month out. Sometimes within a week you can hit that stop gain. And so I don't really like to tie up the capital for the final 3 weeks just to eke out that last 50%. So I will do the stop gain. And then on the other side, if it goes up to $3.36 premium, that would be the 50% stop loss. And I'd be down 50%, and it would be time to close the trade and move on to another target. That's just what I do, but Iron Condors are really good. Now you'll notice that the price is here, and this Iron Condor is built on the low side. This is for bearish people. This is for people who think, this is where the AMC's future is heading. Well, what about the people that think it's going the other way? Well, just like butterflies, you can adjust these and you can put these anywhere you want. Any market bias you want, you can build. Great thing about options trading is you're never limited to what you can do. Sky's the limit, up to your imagination. But let's go put side. Let's do the 45, just out of the money right now. Remember, AMC's trading at about 50, give or take. And then on the high side, so now here's today's price. We can't even see. This is such a lopsided trade because, again, the options market, I'm not saying AMC is not going to go up, but the options market is pricing in that it is unlikely to go very high for very long. So that's why you're risking $83 and you can make as much as $417. And that happens all the way. So if we go really crazy with this and we actually take the highest strike available, the 140, which is pretty ridiculous, this is what that trade looks like. So it is still an Iron Condor, still risking $140 to potentially make $360. And that happens all the way up to AMC at 140. And the break even all the way at 143.60, something like that. So if you're interested in a bullish trade that is defined risk, that won't get you into trouble with implied volatility, and won't mess up your margin in your account, this is something that people could consider as well. Now, personally, I would probably still default to a broken wing butterfly, and I might just skew it so the upside has a little bit of profit as well. But the great thing is you can see about the Iron Condor is that there's a pretty wide profit range here. And the price can even go down a little bit, down to 40. and the trade is still okay. In fact, we could probably adjust that to, lower than that. Let's just see what it looks like. Let's go all the way to 30, just for fun. It's going to start to look a lot worse the lower you go. So 30.25. So yeah, obviously the market is pricing in that AMC is likely to go lower. So now we're risking 293 to make 207. But the profit range is from 30 to 140. So pretty solid range there. Anyway, that wouldn't be my favorite trade on the high side, but certainly on the low side. That's this right here. This is a trade that looks, based on my risk and how I typically trade, this is looking pretty good. Very wide profit range. You know what you're going to risk ahead of time. That's a really good trade. So those are the three that I would classify as not only good for AMC right now, but like I said, three option types that you definitely want to understand for the future, because these can apply to all of your options trading. You can use this, just put them at the top of the list. Anytime you're trying to analyze a stock or index or a trade, go through these and think, is a vertical appropriate? Well, if that's not the risk profile you're looking for, go to the butterfly, then go to the Iron Condor. Another one that people will be saying, get a lot of comments on this one, so I'm going to highlight it. Like I said, a little extra here. I've labeled it yellow. There's nothing wrong with calendar spreads or diagonal spreads. Even on AMC, there's nothing particularly wrong with it at the right time. But what I want to draw attention to is how badly this can go for people if you're not prepared for what it could potentially mean. So, ominous warnings there aside, let's build a calendar spread at 35. So what a calendar is, it looks very similar to the butterfly, looks very similar to the Iron Condor-ish. It's basically both sides losses, middle large range gains. And some people might think that this is a very safe trade, because on my checklist, remember, we are buying and selling premium. So implied volatility should be fairly negated there. We're using the same strike. So again, it should be negated. And the max loss should be capped. So this should be a pretty safe trade. The reason that I want to draw attention to it is that calendars in particular, because you're dealing with two different monthly expirations, that's how the calendar is built. The front month is the short, July 16th. The back month is July 23rd. We're talking about two different implied volatilities. You can see those here. The implied volatility is different on both of these strikes. So it's not actually the set and forget type of trade that some of the other ones are. You have to be careful, and you have to understand that implied volatility plays a role here. The second aspect is, you can see Vega. Vega is the option Greek that represents how much we can expect the option price to change based on a 1% change in volatility of the underlying. So as volatility goes up, calendars have an advantage. If volatility goes down, calendars have a disadvantage. That is very important with the calendar to understand, and I'm going to show you why. Remember, implied volatility right now is 260%. And I've already said that we are in bizarro world with AMC where everything is flipped. Typically, when stocks go down, implied volatility goes up. When stocks go up, implied volatility goes down. That is not what's going to happen here, and that's not what is happening for this whole time. If this goes down, don't be surprised at all if implied volatility goes down significantly. This could go down to this level again. If people start losing the interest and, the waves of long calls and stuff start to fade, this thing could really quite quickly go back to 150-ish, maybe even 100 implied volatility. Well, that doesn't really matter for the other trades I was talking about. So these are still all totally good. For yesterday's terrible trades, that's very, very significant. But today's stuff so far, not a big deal. But the calendar, watch what happens. Let's say you're a person who thinks it's going to go to 35, and it does. You timed it perfectly. You got your calendar, it expired at 35 a month from now. You nailed it exactly, and you think you're going to make $365. You're risking 100 to make 365. Watch what happens if you get a minus 100% volatility decline, which again could definitely happen. If AMC is 35 a month from now, let's even add a little bit more. It could actually go back down to 100% from the 260 it is now. Watch what happens to this calendar. The max loss didn't move. It's still a defined and everything looks great. But that middle range has now crushed down to where you made $86. And now it's a super tight range. You have to get it between 33 and 37. That's what I'm saying, is that calendars are very Vega sensitive. And likewise, let's boost it up plus 150 implied volatility. Again, that's not going to happen. If AMC is at 35, volatility is going to go down. It's not going to go up. But let's assume that it goes up just for the example. Now the calendar looks amazing. Same max loss, but now the middle price is at 650. Again, calendars, very, very Vega sensitive. So I'm not saying that this is a bad trade. In fact, I think calendars are great trades. I can just show you my, this is one of our past emails from the VTS Options community. VTS Options itself has been temporarily put on hold. Now we're all focused entirely on the tactical VTS strategies. We're going to come back a little later in the year and do these again. But you can see here, one of my strategies is called Condor Calendar. I like calendars. Another one is called Calendar Roll. Calendar Roll is a strategy that I use where you adjust the long strike. Where's my calendar here? This long strike, I could set it for 3 months in advance. And then you repeatedly sell the short strike over and over again to try to build up enough premium that it ends up paying for the long strike, and you end up with a long-term profitable trade. So I like calendars. Calendar Condor. Iron Condors are much, much better for mid to high volatility. Calendars should only ever be opened when volatility is low. And that's why I'm bringing it to people's attention, because if volatility is going to crash down, you have to be aware that now is not the time to be opening very sensitive long Vega trades. This thing could collapse down on you. Same with a diagonal. Diagonals are the same. They're just using a slightly different strike price. But just be aware that right now, here's this Iron Condor. Let's do our volatility adjustment, what we're expecting. If it goes back down to this lower range, we're expecting minus 100. See how the Condor was assisted by that? We're going to actually hit our max gain pretty quickly. We're going to stop gain at our 50% profit line quite quickly if Vega goes down, which is what we're expecting. It's not going to stay at 250 forever. That calendar could really surprise you. So not necessarily saying that calendars are a bad trade. I am just saying that you want to be very careful with them. And typically, as a general rule, you only open calendars or diagonals during low volatility times. So for my Calendar Condor strategy that I said, probably 75% of the time I'm selling Iron Condors. And on the very low vol side of things, if the market's very stable and calm, that's when I might start moving into the calendar spread. Because if it's already 10% vol, I mean, how much lower could it go? But if it's 260%, wow, you are opening yourself up to potentially being blindsided by implied volatility. Could really change quite wildly in something like AMC. So just be aware. It's highlighted yellow. It's a good trade. I don't want to, tell people not to do them. But again, I don't tell people what to do or what not to do. But I think now for AMC, verticals, bearish, long put verticals. If you're bearish on the stock, short or long call verticals. If you're very bullish on the stock. Butterflies, broken wing. Again, break the wings compared to where you want to shift that risk. If you want high side covered, so just in case this thing goes crazy and goes to 150, break the wing, put very little risk on the high side, put all the risk below 20, and that's a very good trade. And then the last one, honestly, Iron Condors is just a very good template. You can just slap it on to pretty much anything, and you can't get into too much trouble with Iron Condors. Again, for me personally, I do use those stop losses and stop gains because sometimes Iron Condors can be very imbalanced. Maybe you're risking 1,000 and you can only make 300. If you want a high probability trade, that typically happens. And so if you use those stop losses and stop gains, you can take any trade and make it somewhat of a 50-50 proposition. So that's what I personally do. And like I said, you're trying to build an options toolbox here. You're trying to understand that not every trade works in every environment, and every stock is going to react a little bit differently. And you want to have the right tool for the job. So start with those three. Let's go back to Let's go back to review the bad ones you want to avoid. You want to avoid these. Obviously, I mean, how many red boxes can I go here? Let's get that one in a big, bright, fat red box there. Don't ever. I mean, just don't. You could have success for a year, and then all of a sudden you get blindsided, and it's all over. You know, you're going to be making videos talking about rogue waves and telling your clients that you're sorry you can't have tacos with them in Cuba or whatever that guy was talking about. I'm talking about optionsellers.com when he basically was doing this, selling way out of the money premium, and then all of a sudden thinking you're a genius for so long, and then all of a sudden it's blown up, and you know, now you're apologizing you can't go on fishing trips with your clients. Karen the super trader, same thing happened. She was a genius. Tasty Trade is promoting this absolute fraud all over the place, and then all of a sudden eventually it catches up with you. You sold naked premium way out of the money. You thought it would never get there. You thought you could roll the things. Turns out you can't roll when you've got 5 things working against you, like your buying power, like your liquidity, like your implied volatility, like the price action. Your broker raises margins, and then Karen the super trader blows up and gets charged by the SEC or whatever happened there. So don't. The other 2, again, they're not awful, but be aware of the risks. The best 3 are here. And then be aware that calendars are quite dangerous during high vol periods. And there you go. That's my take. Just little tips there on defined. Have I been going 55 minutes? Oh my God, I'm so sorry, everyone. I'm like that. I'm sorry. Oops. Sorry, everyone. Well, I hope you found value anyway. I had no idea. That felt like 10 minutes. I am really not very good at this live stream stuff. God, I thought I was talking for 10 or 15 minutes. Okay, well, let's just, I'm just going to shut up. Let's get to the Q&A. Again, I really like to favor the Q&As because I know how difficult it is for people to get their questions answered. You know, everybody out there they're doing their own thing. They're managing their own business. They've got their stuff. They just don't have time to answer any questions. So I would like people to know that I'm here for you and willing to do this. But I was just blabbing for 55 minutes. So hopefully you found value. Let's get right to these. Let's see if there's any questions. Yesterday there was 1 million. I noticed that too. When you're talking about negative things, people like that a lot. When you're talking about positive things, nobody really tunes in. When you're talking about making money very quickly, thousands of eyeballs on the thing. When you're talking about risk management and safety, who's interested in that? So I don't suspect there's going to be as many questions today. But here's the... So what do we got here? We got a... What is that black thing? I don't know what that emoji is. Is that something to do with like an ape hand? It's really small, I can't see it. But then we've got the diamond hands, we've got the moon. So I'm pulling for you. I have no position in AMC, so I'm pulling for you diamond hand people to keep sticking it to the man. Not really. We don't know if the man is actually short these things, but that's the narrative, so keep going. Good stuff. Brandon McCann just signed up for VTS yesterday. Thank you very much. There's a 2-week trial. There's no commitment. Anybody can do that. Just go on the website, take the 2-week trial. You'll see all of our trades firsthand for a couple weeks, and you can decide later on if it fits into your risk tolerance. And I tend to be a very secure, stable, long-term investor. I'm trying to make my 15 to 20% a year forever. I'm not looking to make 200% in a year or anything like silly like that. I don't think that's possible for very long. I think when people do that, they're going to blow up their accounts. So, but yeah, thank you very much for signing up for the trial. Been watching your videos, worried about valuations, Buffett indicator, avoiding drawdowns, timing couldn't be better. Yeah, I'm not saying I'm worried because my trading functions day to day based on tactically rotating into the right positions. So currently we are basically all in the market. We are long equities, short vol. We have been for a while because of the way the market's been behaving. But I can change in one day. So I would say I'm worried about the market, but I'm not worried about my portfolio's reaction to the market. I think that within a day or two, we can pick up those volatility signals and we can move to our safety. But yeah, I agree with you that some of these valuations and certainly some of those indicators that we look at, the Shiller PE ratios and the Buffett indicators, just based on the way the market's been behaving since COVID, but also before that, since basically Volpocalypse in 2018, I just don't think those metrics hold as much weight as they used to. It's a different market these days, and we just have to adapt to what's in front of us. It's the same thing with AMC. I mean, 2 years ago, this AMC thing would have fizzled out very, very quickly. We would have been looking at a chart. It would have spiked up, crashed down, totally expected to crash, would have made a second attempt here, and then it would have fizzled out and died. This is just a new world, and it's just a new market, and we do have to adapt. So I would caution people against using those sort of traditional metrics that we look at. I just don't think they're very useful. Follow up here, trapped in a buy and hold long-term investments, Apple, and I also sell long-dated puts on portfolio margin. Well, check out yesterday's live stream where I was talking about the risks to selling puts. Apple is more stable than AMC, but if it crashes down too far past your strike price, you might find that the covered calls you're able to sell on the other side are not very impressive. So be careful of that. Adding TPS. So thank you. Thank you for all the compliments and trying the free trial. Love it. Good stuff. What about long straddles? Long straddles fall into the same category as long call options or long put options. They're not necessarily bad. I'm not saying they can't make money. They certainly could. Anything can make money. But you're paying a lot for that premium. Long straddles are long vega, and the premium's 260% implied volatility. So you're setting yourself up for those wings have to go pretty wide in order to really get your break evens. Again, it's not a terrible trade. Short straddles are worse because then you're bringing in implied volatility and margin requirements and all that stuff. Don't ever sell naked premium. But yeah, they can work. I don't do it. Why not choose a direction? If you're choosing definitive directions, verticals, long call verticals, long put verticals, definitive direction choices. If you're sort of unclear, broken wing butterflies. Make it half and half. Make a little bit of loss, a lot of loss, big profit in the middle. That's what I would default to. The long straddle where you're basically just saying, I don't care what happens as long as it moves a lot in either direction, you're paying a ton for that premium. So tough trade to make money on. The only time I really do long straddles, let me pull up my list of option strategies. The only time I personally do long straddles is strategy number 5 with earnings plays. The reason that long straddles work so well as earnings plays is, what do we know about earnings? Well, one of the fundamental aspects of the market, you can't predict volatility, but there's one time that you kind of sort of can, and that is scheduled events, earnings. So what typically happens, not always, but implied volatility will rise into an earnings event. So what I like to do, not always, but when the situation matters, I will buy long straddles, anticipating that vega is going to help me for a few weeks. And then before the earnings are announced, you close out the trade. Don't ever wait till the earnings, because once the earnings goes, volatility collapses and your long straddle's in a lot of trouble. But there is that volatility ramp. Not always, but it's a slight edge for an option trader. And that's all we're really trying to do is, there's no slam dunks here. We're just trying to get that risk reward profile slightly in our favor, adjust those probabilities so we are more likely to win than lose. And that's the only time I will be using long straddles, pretty much, because you're paying a lot up front, and it's an awful tough trade to make money on. Buy out of money calls, AMC, GME, Clove. So of course I know what AMC, GME. We've been doing streams and videos on that. I'm still not up to date on this Clove rocket ship that you're saying here. But good luck. Not all of the Wall Street Bets picks are going to rocket to the moon. So it's not quite as easy as just following that forum and then buying everything they buy. It's not quite that easy. It's actually really difficult to shock the market upwards. So not all of them will work, but some of them will. AMC will fizzle and die eventually. It's a terrible company. But then there will be another target that works really well. So this is not the last we have heard of this. This new social media influence type stuff, it's here to stay. I personally believe that's what's holding crypto so strong. you just get so much buzz behind it. There's nothing, I don't want all the crypto people to get mad at me, but there's nothing fundamentally good about crypto. Don't hate me. I have my opinion. I don't think it's world changing, but I think the reason it's been doing so well and probably will continue to do well is the same reason why there's going to be another AMC, there's going to be another GameStop. When people with a large audience can get a whole bunch of people on board, you're not printing money, but it's a pretty good momentum on, at your back there. So yeah, Clove, good luck to Clove buyers. I don't know how many people are watching this, but anybody who is, apparently Clove is the next one. Full disclosure, I don't even know what it is, so that's not a trade recommendation. Neutral to directional verticals, useful. Yeah, those are what we kind of stick to. TPS month. I will get the monthly returns typically for, they're released around the 10th or 12th, so I'm right about the time. It's Sunday. I'll probably do it. The reason I don't do it right on the first day, I actually kind of wait, is benchmarks, right? Comparing to the hedge fund index, comparing to the SIBO Eureka hedge fund index, those are not released until about the second week of the month. So typically my results on the website go up roughly, what have I got up there? Just to kind of make sure I know what we're doing. I've got... Yeah, I'll get these May results up as soon as the hedge fund indexes and the benchmarks are done. So tomorrow, yeah, I'll get that done for you tomorrow for everybody watching. AMC call options are way overpriced. Might as well just buy shares. Yeah, the thing I said, this is exactly right. They're way overpriced, of course, with implied volatility at 260. But... like I said, there's a little 10% sliver there where long calls, it might not be the worst trade in the world, just simply because in order for a long call to make money, you have to have a pretty violent move pretty quickly. Well, if that doesn't describe AMC, I don't know what does. So it's not the worst trade in the world, but I agree that it's, objectively speaking, way overpriced. There's no way that you could make a case that it's cheap to buy calls here. It's just not. It's very, very expensive. Puts as well. People who think they're the smart money, it's going back down to 20. Those puts are so expensive right now. So thank you for checking out the stream. But did I say something wrong? Oh, this is for another person. Thank you for the suggestion. So was that Clove person? Yeah, there you go. Giving recommendations, other people picking up on it. Let's all put $1,000 into Clove, right? No, that's not. No, I didn't just say that. I like closing at 50% or other amounts using daily P&L because the capital tied up is still the full risk as potential additional gain is reducing. Yeah, this is my exact point. For Iron Condors, if what you think is going to happen when you initiate your trade, if it actually does happen, like this trade, for example, remember we highlighted the other one that is just way up there. But this trade, for example, if this does slowly start to bleed down into our bulk of our profit range, that would mean people are losing interest in the stock, right? It just would. And so we would be expecting that volatility would click down and we'd be about here and we're kind of profitable, and then it might click down to 100. By the time it gets to 35, we might find that we're at 50% profit for after a week. But why should we wait for the final 3 weeks to just get that last thing when we can just turn around and instead of doing the July, we can jump right into the August and do another trade? We can always allocate that capital more efficiently by not having to wait the full expiration. Plus, another thing to bear in mind is gamma, the option Greek that represents the relative changes in delta, the speed of change and how much your options can change, delta increases dramatically as you approach expiration. So we call that dancing on the gamma knife edge, where you don't want your contracts to go very close to expiration because small changes in price can have a very large impact on what you're doing. So both, don't tie up your capital on a trade that has already made half its money quickly, and B, don't dance on that gamma knife edge. Get your trades done, get your profit, or stop loss out, no loss, no foul, just move on. You don't want to push these things too far to expiration because violent moves can happen close to expiration. So I would avoid that. Vanessa's my biggest fan. Thank you for watching. She always gives me the thumbs up before sleeping. She's in Taiwan, so of course right now it is 2 in the morning. It's pretty late to be up. Hopefully not out. Always awesome. Is this toss? Be great to show the builder and interactive brokers. Yeah, so what I'm showing always is toss. I love thinkorswim. I think this software is really, really nice to look at. But my long-term portfolio is at interactive brokers. This is just an account that we have open that we can do, we can test strategies. The positions that I'm currently holding, this is our leverage total portfolio for, our VTS. We are essentially this portfolio, right? We're doing the MVV, SVXY, QLD, and then a VXX short put. That's all of these positions, right? That's just, this is the balance, this is the defensive rotation, this is VB threshold, and this is vol trend. And then this one is tactical vol. That's what this is. But this account is, full disclosure, of course, it's a live stream. This isn't actually my long-term portfolio. So I use interactive brokers. The problem is, look at how nice this looks. I don't know if you've ever seen interactive brokers, but it is easily the ugliest software you will ever see. So I never show it in videos, and I also don't like to show my long-term portfolio just for personal reasons. I don't think it's a good idea to be sharing, net worth and, look at how much money I have. Just personally, I don't think that's a good idea for people in the social media age, 2021. So we've got that account open to do all of our trading in a nice, beautiful thinkorswim platform. So maybe one day I'll show or interactive brokers. They have the they've got the same functionality. There's nothing wrong with interactive brokers. And in fact, the reason I was at IB, I moved over in 2011, was because back then fees were way cheaper. The accounting was much better. The service was better. thinkorswim was expensive, it was slow, but they had that beautiful platform. Nowadays, it's a little bit closer. So, people from IB could move over to TOS and you're not giving up a whole lot, but then you get that amazing platform. So, but that's the reason that I don't show interactive brokers. I just, ugly, and I don't like to brag about money. So we've got a nice little test account there. It's good enough to take all of our trades, demonstrate everything. I could have even taken these trades, to be honest. If AMC was live trading, I mean, we can do that. That's what this account is for. I could have taken a one lot in all of these, and I don't know, maybe I'll consider doing that when later in the week. That would be kind of interesting. But yeah, all brokers these days are pretty similar, just in that there's a race to zero in commissions, so there's a little bit less separation between them all. Okay. I'll die without my coffee. What's your opinion on ratio spreads? AMC long, short 2. You only start to lose at 180. Ratio spreads are also good. Well, I don't know about good. They're something to trade. I personally don't feel like they add anything that the other three don't already cover all those bases. So ratio spreads, you get that picture. Is that really adding anything more? I would personally rather just use verticals on both sides if I'm definitively drawing a line in the sand. I'd rather use Iron Condors if volatility is a little bit elevated. I'd rather buy calendars if volatility is very low. And then broken wing butterflies can fill in all of the rest of the gaps. With just those trades, verticals, condors, calendars, and butterflies, you can trade any market bias you have. You can cover all the bases, and you can do the whole thing knowing your maximum gain and loss, knowing that your margin's not going to change, knowing that all of those things, rising and crashing implied volatility, is not going to make or break you. That's your toolbox right there. Then there's a whole bunch of other things that you can, I think they're more, sometimes people do them because they sound cool, but ratio spreads are one of them, back spreads, ratio spreads. People will talk about jade lizards and things like this. Sure, they're trades, but they don't add anything to the basic toolbox. So I find them, they're not bad. And if you structure them well that match what you're trying to achieve, just fine. I just personally find no additional value to taking them up as opposed to the other ones that I went over. Keep things simple whenever possible. Get really good at a few strategies, and you're going to be able to apply that and make a lot more money than if oh, I'm going to do a jade lizard here, and I'm going to do a back ratio here, and I'm going to do a vertical this time, and then a broken wing butterfly. And, I would just have a very small, efficient toolbox of about 5 option trades, and you are good to go. I can actually show that. Let me see what I personally do. So I've got about 12, and some of them enter and exit the portfolio at different times, but at last, when we were trading, these are the 7 strategies that we were using. So Voltrend is selling put options on VXX. So we've got short puts. We need that. Wheel of Fun is also selling short puts, but it's on more stable things that we can turn around and sell covered calls later on. Can't do this strategy on VXX or UVXY. Definitely can't do it on AMC. It could go, if you sell a 20 put and it goes to 10, your covered call follow-ups are going to be worth absolute pennies, and it's going to be disastrous. But short puts are a good trade to have. Condors and calendars, like I said. Vol-step is verticals. Vertical spreads on volatility ETPs. Wheel of Fun is short puts and short calls, followed by cash secured puts, cash secured calls, covered calls, all that stuff. Earnings plays are long straddles. Directional flies are broken wing butterflies. And then calendar roll is what I said, making sure that the calendar, the long strike, is far dated, where you can get several shorter dated contracts in that time frame. And hopefully all the cumulative gains from the short calls can pay for that long call. And eventually you're riding something for free and into profit range. So, condors, calendars, butterflies, and verticals. That's really the meat of everything that I do. And then we've got, if you want to see what the emails used to look like, we used to give the trade instructions, talk about the margin requirements, risk management. You can see I'm using the stops, as I explained, because today's trade, that day, January 20th, was a Iron Condor on the SPY. So I am using my 50% stop, 50% gains there. Portfolio allocation, what all the Greeks are compared to a short Iron Condor. Our volatility metrics, essentially our volatility barometer, and open trades. I guess at this time I had a couple of condors and a short put on VXX, and then always a video explaining everything. So, but yeah, like I said, the meat of my trading, hopefully I was doing a screen share there and you saw all that. Verticals, butterflies, condors, calendars, and then short puts. You can do literally almost anything with that, and I would build out from there. You don't really need ratio spreads. You don't really need jade lizards. I mean, you can go on and on. There's tons of different things you can do, but you don't need them. You've got the bases covered with what I went over. Calendars look good now if avoid meme stocks. Some of them, calendars are the sort of the default go-to trade during low vol periods. So right now in the market, I wouldn't say it's low vol, but it's low-ish. Remember, volatility is always relative. It's never absolute. So I hate the VIX index. I've many reasons why I hate the VIX, but on an absolute level, it's very high right now, 1565. I target sort of an average VIX at around 14. The mode of the VIX is 1242. The median of the VIX is 1744. The mean of the VIX is 1946. I kind of average them all out between the mode and the median, and the average VIX is about 14. So right now, it's not even relatively low. It's not even low on an absolute level. But on a relative level, volatility is very low right now. So yes, even though volatility is currently, it's up there, relatively speaking, calendars would work on a large number of underlying assets right now. Calendars would be a pretty decent trade. But as you said, not on AMC with IV at 260%. So some of these have premium super with volatility. Never look at the site with ugly logos, so only secondhand news for me. Some of them like this. Don't know. But yeah, absolutely. Calendars are awesome for low vol. They're one of my go-to 5 strategies. Not on AMC and not now. Reason being, implied volatility can collapse, and your profit margin, which you thought was this big, can fizzle out and die quite quickly. Would calendar spreads benefit from an increase in IV? Yes, they do. So like I showed, the max loss is not going to really change, but you can get a much wider, healthier looking trade if IV expands when you're holding those calendars. Is that likely to happen now? Well, maybe on the call side. So that's why when I went over these trades, you can do long put calendars, but you can also do long call calendars. And in that case, yeah, if you think it's going to 130 and you opened let's just show one of those, why not? If you think this thing is going to go, let's unclick that one. I don't know. What do you want to call calendar way out at 100? If this trade, I don't know how good it's even going to look because IV is very strange these days. But if you get an IV expansion with this trade, watch what happens. So let me see if I can get the break evens right there. Watch what happens if you get an IV expansion. So if AMC does go to 100, I'm expecting implied volatility to go up certainly another 100%. Oh, sorry. Let's adjust these. So that's there. If we get this extra 100, you can see it widens out from there, and it gets really wide over here. It's actually this wasn't the one. It was that one there. It's a much better trade, and the max gain in the middle bumps up as well. The problem is if it goes the other way, the calendar gets absolutely smushed, right? It goes down to that zero line pretty quickly. So as I said, calendars are good, but very Vega sensitive. Be aware. They're not set and forget like the other ones. You enjoyed the 55 minutes. Yeah, I'm sorry. It went so long. I had no idea I was talking for that long. So for those who enjoyed it, it was probably nice. For those who didn't, quite punishing. Get to the Q&A already. Everybody's screaming. What about selling calendar spreads on vol peaks? Yeah, but what's a vol peak? I don't have that skill. I don't have that crystal ball that knows what the vol peak is. I guarantee you, if we go back 2 years and I asked you what's the volatility peak, you would have said, I'm going to start selling calendars or buying calendars because the short is the close month and then the long. So buying calendars. You would have for sure said the volatility peak, the VIX at 50 that's the peak. Because in 2011, it only went to 50. In the 2015 crisis, it only went to 48? Volpocalypse, Q4 2018, it went to, in the 40s, 54, I think it topped out. But you certainly would have said that. And then you buy your calendar when the VIX gets to 45 or so, and you think, well, I've got it now. It's nothing but Vega crush on the way down. And then the VIX gets to 82.69, like it did during COVID. So what is a vol peak? That's a relative term. That's not an absolute term. So you want to be careful about your ability to predict the future. But yes, in general, your point is correct that, wait a second, I flipped this actually. You're talking about selling calendars. Sometimes I do that. Live streams, you don't read the question carefully. I'm talking about selling calendar spreads. No, they get out of control too quickly with IV. So sorry, I misread your question there. I thought you were saying that you were going to sell volatility at the peak, but yeah, I botched that one. Sorry about that. But no, when you start mixing it up, then you're too susceptible to the implied volatility movements as well. And then what I said about knowing the peaks and the troughs, that is very relevant as well. Well, I'm not saying you, but us, the proverbial you, we don't know what the peak is. We don't know what the trough is. We don't know what high is. We don't know what low is. We can't predict markets like that. You can put the odds in your favor, but calendars are very sensitive to volatility, so you better be right. I think this was asked already yesterday. I asked this. I answered that. You asked this, and I answered this. Unless it's just a shockingly similar question. I'm not a buy and hold investor, so I think in general, long term, TQQQ is the triple leveraged Qs, the Nasdaq basically. Obviously, I'm bullish long term on the market because for 100 years it has gone up, right? So long term, buy and hold, sure. Just painful drawdowns. I mean, remember the Nasdaq itself had a 78% drawdown in the .com bust. You're talking about holding a triple leveraged of that. I mean, I'm not saying that we're going to repeat the .com bust, but the stock market crashed 56% in 2008. Why couldn't the Qs crash 60 or 70? And then you're talking about triple leveraged. Nope. No thanks to that. But yeah, long term, if you just closed your eyes for 30 years and came back, you probably would have made money. But pretty much every investor under or overestimates their risk tolerance. They think, oh, I can sustain a 50% drawdown. It's fine as long as I'm going to make a big profit. And then they get the 50% drawdown and they're out. They sell at the bottom, they capitulate, and it's over. So if you think buy and hold TQQ, I would guess you're probably wildly overestimating your risk tolerance, is what I would say. The emoji was an ape. Yeah, I kind of figured that. It was like a fist for an ape. That's the new thing. Again, I'm old. Don't hold it against me. I don't know these, forum lingos and diamond hands and all that stuff. I kind of stay in my lane, stick to my strategies, but I'm on Twitter too. I see them. I kind of know that recently you guys have moved over from the diamond hands to now it's something about laser eyes, and then it's apes and bananas. So as long as you all make money, it's fine. Do your thing. There's lots of questions to ask. Just everything is way too advanced to be understood. Meaning that you don't want to ask things that are too advanced. Typically people don't, but I agree with you that sometimes if you ask something that's quite complicated, sometimes I'll just tell you to email me, because few people will be interested in the stuff that gets really high end. Like, that's why, I have a math background. I could really geek it up if I wanted to, but it's just not helpful for an audience to do that. So I agree with you that I try to keep things simple. I'm not an educator, but I try to get my message across to a broad audience so that they can sort of get started in their trading journey. Once you reach a certain point, the things that I'm saying are going to be less important to you anyway. The better you get, the less relevant I am going to be. So I try to understand that I can be of a lot of help to most investors early, middle in their stages. But once you start to understand the super advanced topics and you had a conversation with me about the advanced stuff, then you don't need me anymore. We're just two friends talking. So I do try to keep my streams accessible for the largest number of people. I find the premium pretty bad versus the downside of the underlying if it does drop. I think there's some crosstalk here, so it's hard to catch up, but sounds like you know what you're talking about there. I think there's something called a poor man's covered call using options. I would, for things like that, I would rather do a full 10-minute video, but yeah, it's one of those poor man's covered call, calendars. It's one of those, again, where kind of like the ratio spreads, it's something that exists out there, but it's not useful to use because the 3 or 4 sort of go-to strategies will cover all your bases anyway, and you don't need to get into those obscure things. But they do exist. Maybe I'll make a video. I have that multi-part option course. Not a course, but just if you go to the YouTube channel and you go into playlists, we have... I'm sure I did it, right? I've got this one. I never finished it. I'll do a much better one later on. But we've got quite a few here. Individual strategies, all explained. Condors, verticals, calls, all of these things, broken wings. I could probably do one if you wanted on things like ratio spreads and jade lizards and poor man's covered calls and things like that. But they're not useful beyond the 3 or 4 that we talked about. Yeah, this is an absolutely true statement. I do not understand Bitcoin. Well, it's not that I don't understand it. There's a difference between not understanding it. I know what it is. I know how it works, and I know how it functions. I would word it as I'm not on board with the use case of it. I've yet to have somebody tell me an actual use case for it that is a game changer, as they would say. It's not a game changer, at least not yet. I am free to be convinced otherwise, though. I'm not the type of person that talks as if I know everything about everything. I have never bought Bitcoin. I've said that many times on Twitter. I don't know anything about it. I don't get it. I'm not on board with the message. If you want to convince me, feel free. In fact, one thing that I might do, I've never done an interview before. My streams and my videos are always just me. But one thing that I kind of consider doing is maybe I should try to figure out how to do a live stream with a person interviewed, and then I'll find some Bitcoin person out there who everybody trusts, kind of knows what they're talking about. Sorry. Seaplane's taking off. And maybe that person can walk me through it, make me a believer, and I'll fund the account with what is now 35,000. What could it be then? Anywhere from 20 to 60. I'll buy my Bitcoin. I'll buy one Bitcoin just so I can say that I'm in the market. And, I'm a believer that it should be a tiny fraction of your net worth, but I'm open to being convinced. I know I don't know a whole lot about it. So, yeah, I didn't, my Bitcoin stance sometimes triggers people on Twitter. It's kind of funny if I even mention Bitcoin. I'll certainly get some responses. I find it kind of fun. But in general, I'd say I'm fairly indifferent to crypto right now. I think it's great people make money on it, but don't be it's like AMC. Don't be surprised if Bitcoin goes to 200,000. Don't be surprised if it goes to 10,000. I mean, don't be surprised if the world wakes up and realizes that Dogecoin isn't worth anything. Don't be surprised. But then on the flip side, I'm not going to act like I'm surprised if Dogecoin goes to $2. That's all I'm saying. Again, with AMC, don't be surprised if it goes to 200. These people can push it much higher than traditional asset managers think. And they're betting against them, and they're wrong, and they're getting hammered. And don't be surprised if this thing rockets higher. But on the flip side, don't be shocked if AMC is $10 a month from now. That could happen too. It's the same as Bitcoin. I am open to the possibility that it changes the world. I'm also open to the possibility that it is one big scam. One big Ponzi scheme. And love to interview somebody, have a real meaningful conversation, no insults, no, hey, you're an idiot because you don't get it. Actually, let's talk Bitcoin. Convince me to buy it. My money's ready. All right, Long Straddle, you're betting the real vol will be higher than is priced in. That's tough here. Yeah, that's exactly a good way to word it, is that when you're buying and selling options, you are essentially betting that your hypothesis will outweigh the market's analysis. So when you're buying a long straddle, you are paying upfront premium, very expensive right now. You're essentially, if you take that trade with implied volatility on AMC at 260%, you are essentially saying you know that the stock is going to move faster and more violently than the market is pricing in. It's a tough sell right now. It is. I agree with you. That's tough here because while we have seen the IV go to 500 or 600, 260 is still very, very high. So Jared asks, I think you're right that this isn't going away. Yeah, my thesis that even though AMC will definitely fizzle out and die, not die, but it'll go back down to $10 soon and it'll be long since forgotten. There will be another one and another one and another one. So yeah, that's my general thesis here, is that this is here to stay. Social media is a real thing. Influence matters. And traditional asset managers should probably get the memo at some point. Betting against social media is going to be a very quick and easy way to lose money for all these asset managers who are unwilling to change and adapt to the times. So what I always say, I don't want to be, right forever and say that I've never been wrong. I just want to be right in the moment, and I want to be malleable enough that I can change my opinions on the fly. Like Bitcoin, I have an opinion on it, but it is changeable. So, yeah. There's been a paradigm shift, in the way people process and share information. Absolutely. Influence matters a lot more than it used to. And maybe it doesn't matter more than it used to, but the benefit now is that people who, how can I word this? I don't mean to say insignificant, but people who don't have those long proven traditional methods of standing out, like you went to Harvard, you worked on Wall Street, you manage a big fund, you're on, Bloomberg News. People who are not insignificant as people, but insignificant in the business world, can now develop massive followings, and they can have just as much or more influence than those people that did the 20-year traditional route and would have been in the past considered the experts and the respected people. Now, the world has changed. You can change where you're at in society much easier than ever before. And in the investing world, this is powerful, and it's been proven. I mean, look at AMC price. That is exactly because people don't like to be told that they're beneath you, right? They don't like to be told that they're not as smart as Wall Street, that you're not as, what do you know? You're just a guy trading in your basement. People don't like to be told that, and now they have the power to say, oh, really? Okay, I will go against you. I'll take that bet. So yeah, it's a different world. It's fun too. Seeing a lot of people who are building brands for themselves on never would have been possible before. So yeah, the world has changed, and people should wake up. This is a wake up call for anybody. The last 2 years of all this stock market action and everything that's happening, there's no way you could make a case that this isn't different. The world is different these days. All right. How long have I been blabbing on? An hour 35. So the first live stream I ever did, I'm still nervous. I'm still terrified of public speaking. But first live stream I ever did was 3.5 hours long. I thought it was 20 minutes. It felt like nothing. And then I've been whittling away, and now I try to get them to an hour or maybe ideally 45 minutes. But I think just because today went so long, I think I'll answer more questions because there's oh my God, there's at least 50 more. We're never going to get to them. So just while I have you all here and have your attention span, just follow me on Twitter @VolatilityVix. I will notify anytime there's live streams, and we always do these Q&As because I think people like to get their questions answered. So follow me there, and shameless plug, give the video a like. There's quite a few people here. Give the video a like. Let's keep going. Does your advice, not advice, but advice, sure, not taking long puts apply to AMC or across the board? I'll finish the question. Does it apply for long puts to short vol via VIX futures or options? So again, like the previous comment made, when you're buying long puts, long calls, long straddles, you're essentially taking the position that you think whatever you're trading is going to move faster, and implied volatility is either going to stay where it is or go up. That's your contention when you buy these types of trades. The market is telling you otherwise, because they're pricing it in. They're saying that the odds of that trade being in the money are not very good. So that's what I would say. It's not really that it doesn't apply to one thing, but it does to another. It's all trading. Whenever you are buying premium, you are paying that implied volatility. So right now you're paying a fortune in AMC, and it applies to AMC. But like you said, with long puts or short vol, VXX trading, VIX futures trading, you're going to have to assess where volatility is now, where you think it's going to go, where price is now, where you think price is going to go, and factor in these things and decide, are you right that this option is priced poorly, or is the market right that that option was priced correctly? That's what option trading is. You're essentially trying to prove that your hypothesis is different than the market's take on it, and you're going to be right. More often than not, hopefully. So it applies everywhere. It applies to absolutely everything. AMC specifically applies now because implied volatility is through the roof. But yeah, it's just a standard thing. You're looking for an edge, and whenever you're trading options, you're essentially telling the market that you know more than them. So hopefully you're right. I have a call broken wing butterfly on AMC right now. How would you manage a broken wing butterfly that is breached? Well, breached itself doesn't matter. You're talking about passing the strikes. Doesn't really matter. It's a set trade, defined risk. So I don't really look at expiration prices. For example, if we go to this broken wing butterfly that we highlighted earlier, Which one were we talking about? So you said you have a broken wing butterfly. Sorry, I'll go back to your comment here. Did you say it was, you have a call? So I'll just assume the same. Okay, just a general answer here for you. Breaching the strikes, essentially, this turquoise line is the expiration value, right? At expiration, that's what the trade's going to look like, and it will not change no matter what happens with the underlying. All I ever focus on with options trading is this pink line, the daily profit. Options trade dynamically. Let me make sure that I don't have that volatility adjustment. Options change dynamically in the moment. So all we care about is this pink line. That's it. There's no way I'm going to let this trade go to expiration. Almost none of my option trades go to expiration. So we just ignore that. This is just a picture. What we're actually trying to decide is, when is our profit enough to take it off the table? When is our loss too much that we have to actually get out? That's the answer. So for you, without knowing any information about the trade, I would say clearly you had a thesis before you opened it. Where's your question? You knew what you wanted to make. Hopefully you knew how much you're willing to lose. The only question you need to ask yourself is, are you there yet? Are you at either one of those things? If you are, then you've answered your own question. It's time to get out. Hopefully time to get out means profit, but if you breached your broken wing, probably you're talking about loss. You're down. Have you breached your stop loss? If you are, close it. But I would ignore the the strikes. That's just setting up a trade. That's not actually how you think it's going to move in the future. It's the daily profit curve moving up and down as the market is changing. So I suspect you know what you wanted to lose. Are you there yet? I hope you're not. Sometimes you just take your losses and go home, live to fight another day. There's nothing wrong with taking losses. Tempted to subscribe because of the Greeks. No, don't do that. I know you're being facetious here, but there is an underlying point here. A lot of times what you'll notice with these option trading services and gurus, we'll call them, please don't call me a guru. I'm a long-term investor. I'm a risk manager. I'm not a trading guru. I'm not going to double your money in 6 months. But what you'll often see is people, they really geek it up with the Greeks, with the volatility, with the lingo that they're using. Please don't be fooled. You don't need a math degree to be a successful options trader. You don't need to speak with the Greeks. You don't need to talk about complexity in order to communicate that you're worth following. I know that this question isn't that. You're just making a joke. But yeah, don't be impressed with people who sound really high-level lingo. Don't be impressed with that. Don't be impressed with people who tell you should follow me because I have a math degree. You should follow me because I have a PhD and I manage this. You're either right or you're wrong based on the actual underlying point. You're not right or wrong based on the level of vocabulary you have or, the complexity of your language. So everybody in the comment section is fully equipped to be a very successful option trader. You certainly don't need to understand, the complexities of, Vanna and, all these things that people on Twitter talk about. Don't need it. Some of the best option traders out there keep things very basic and simple. So, yeah. Got that one. Clove again. I don't know what Clove is, but everybody seems to think it's the next one. Please stop reading comments about Clove. It's a pump and dump to fund shorting GME. I don't know. Who knows what? I mean, it's on my radar now. I typically stick to what I trade, and I don't branch off too much from that. But it's on my radar. I'll glance at it every few days. GME is a pump and dump. Well, they all are. Come on. They all are. But that doesn't mean that money can't be made. So, Interactive Brokers Options Builder blew my mind. Not the easiest to use. I love Interactive Brokers service. Yeah, I would agree with that. Interactive Brokers itself, the analytical tools and everything that they offer over there is really great. Like I said, personally, I moved over there because of fees. That's really the only reason. Thinkorswim in 2011 was just too expensive. I was a very active, more option trading back then, super active options trading. And you can't be paying that much money for your options. These days it's quite cheap. So I think, I don't even check these numbers, but maybe Thinkorswim's making a sort of a revival. There was a time there where I would have advised against using it, and a lot of people would have said, Thinkorswim's just too much. Nowadays I think people can come back for just the awesome software and how good it looks and how easy it is and intuitive and user friendly. It's pretty awesome. But yeah, I'm still stuck with my long-term portfolio at IB, and it's ugly every time I look at it. All right, at what price does AMC have to drop in order to have hedge funds, I suppose, stop losing billions? We don't know what their bias is. I know there's a lot of reporting on everybody thinks it's us against them, and hedge funds are the ones that are losing billions. It's probably true in some cases, but it doesn't have to be true. I mean, you never know what somebody's bias is unless you're that person. Even if you saw the reporting of what trades they're in and what size, you don't know if those are offsetting some other portfolio somewhere else. If somebody buys a bunch of VIX calls, you'd think that's bearish on the market, but maybe they're hedging a very exposed long market portfolio. Maybe it's doing tax harvesting. You don't want to sell your portfolio, so you have to buy the options. You don't know. Everybody builds their trades differently. So I know a lot of us sort of in our hearts would, not that we would get joy by seeing other people lose money, because those are real people too. I mean, the hedge fund manager, I'm sure they're not going to lose their $5 million home, but their clients, I feel bad if they lose money. But there is some aspect to people having a little bit of joy that hedge funds lose money. We just don't know if they are or not. I mean, it's just not easy to tell those types of things unless there's very public blow-ups. But have you lost money on AMC? If you're talking to me, I've never traded AMC. AHAS. Maybe you're not talking to me. But if you are, no, I have not traded AMC. I'm just helping people out on how to do it safely if you were to do that. Listening to your boring perspective is better for my portfolio than being shill-hammered to trade naked futures. Yeah. I am boring. I am stable. I always talk about risk management. I'm trying to make everybody who listens to me a multimillionaire, but I have a little bit different way of going about it than your typical people that you follow online. My strategy is actually quite simple. My strategy, I can just show you. This is going to blow your mind with the simplicity of what this is, but here we go. You want to be a multimillionaire? You don't need diamond hands on AMC. That might help a little bit, but here's what you do. Get yourself a stable income so that you can take care of all your bills and everything's good. And work hard and grow your income. Everything surrounds income in this world, so definitely focus on work. Don't focus on fast money, quick money. It's all about building a long-term stable income. Secondly, live below your means, of course. Don't fall victim to all this, consumerism that is surrounding us. Personally, I could, not being a dick here, but I could jump in and do that if I wanted to. I could flash cars and houses, but I'm a minimalist. I'm a digital nomad. I live below my means. I don't buy expensive things unless I really need it. Save money every month, stuff it into your trading account. Third, of course, be consistent. Try to ignore everybody that's telling you that you can make this massive, outlandish rate of return. You definitely can't. Try to stick to that 10 to 20% range annualized return. Be consistent and effective long term. And 20 to 25 years later, you will be a multimillionaire. So that's what I'm trying to do with my work. I'm not a trading guru. I'm boring, as this person has suggested. I am boring and consistent. This makes me happy to look at. We have hardly any drawdowns in our portfolio so far. Really good long-term rate of return. This is what I'm about. The reason that we're doing this stream today, even though I've never traded, maybe I should turn that down a bit. The reason that we're doing this, I've never traded AMC like this person. I don't know if you're talking to me or not, but nope, I haven't. But that doesn't mean that I can't help you default to my style of investing, which is risk management first. Start with safety. Find the safest trade structure you can get, and then try to look for ways to add profit. the reason that so many people failed, 95% of investors out there make less than 5% rate of return per year. The reason is because they're starting with risk and then they're looking for ways to control that risk. That's backwards. You should start with safety and then look for ways to add profit. If you always go from that perspective, you'll never get yourself into trouble. And you're never going to take a big drawdown that costs you 10 years of your compounding time horizon. And that's what I focus on. So yes, I take this as a big compliment that I'm boring. I'm also just a boring person. I'm just a boring, consistent person. I eat the same food every day. I go to sleep at the same time every day. I wake up at the same time every day. I'm just a very regimented, consistent person. But yeah, listening to people like me from time to time, and then balancing that with all the fun and excitement that's out there, maybe that's a good way to do it. Hopefully I can be your boring guru. I find ratio spreads are great for large accounts. They can be, because I don't know why that would be the case, other than typically when you set them up, sometimes they do cost a little bit more in the margin to set them up. But no, that's great if you like them, and there's been several comments about ratio spreads. If you like them, that's great. I just don't feel like they add anything beyond my verticals, butterflies, condors, calendars, and that's my basic template. And I don't really find any use otherwise. They don't add any completely new way to attack the volatility. It's just it's a different way of doing the exact same thing. So, but if you like the look of it, if you like the way it sets up, if you have a portfolio margin account and you think it's very efficient for your capital, then go for it. There are trades out there too. It's just not on my top 3 list. Okay, Bitcoins like Cosmos, Atom, Ethereum, Classic, Solana are all dumping badly. Are they? I don't look often. I'd say I look every... The only way I really even look is if somebody on Twitter says something and it catches my eye. Oh, they're crashing, and then I look. So Bitcoin's at 37,000. I don't even know what these things are. Cardano, Dogecoin. That's so silly. Sorry. If you're a fan, do your thing, make your money. I hope you have 10 Lamborghinis. Well, actually, I don't. Don't be a consumer. But I hope you have enough money in the bank to buy 10 Lamborghinis and then choose not to, because that's silly. But make your money and then be aware at how quickly it can go the other way. As the boring risk manager, I have to tell you that crypto to the moon and crypto to zero, probably about equally likely. So price your trades accordingly. All right, we've been going for almost 2 hours. We have to stop this. I can always do more. I think more streams, shorter time is way better. So let me just scroll for one that just jumps out at me. Okay. Just because I like numbers. I'm a math guy. 2 weeks ago, AMC Volatility was almost 1,000. I think it peaked out at 609, didn't it? So I assume what you're saying is here. It peaked out at 366, but actually it went as high as 604 during the initial phase where it was going from 2 to 20. Let's zoom in on that. Right here, implied volatility went to 600 right there. And then this peak, it went to over 500. So again, if we're having a third wave upward, if laser gorilla diamond hands have their way and this thing goes to the moon again, I would expect implied volatility to crack certainly 400, but maybe 500. Maybe it would even test the 6. It would take a lot, because typically volatility does sort of have lower highs as it goes, because you can't shock people 3 or 4 times in a row. It tends to be a little bit less urgent to get those hedges on because people are gradually hedging higher. Essentially, that's what the VIX index is, right? If the VIX index is pricing S&P 500 options and the VIX is really high, well, it typically means that the market is, at least partially at that point hedged. That's what makes the VIX go up. So you can't really keep shocking over and over and over again. It tends to have lower highs. So, yeah, I wouldn't expect it to get to 600 again. But 4 for sure. It's 260 now. 4, price into your option trades going forward. Could go to 4, could go to 100. I'd say those are the 450, 100. If AMC goes down to 10 or 15 or even $20, I would expect implied volatility to be in the mid 100s, maybe even the low 100s. If we get another rocket ship to the moon and AMC goes to 150, I would expect the 450-ish range to hit. Remember, it's inversed. Typically, when stocks go up, volatility goes down. Not with AMC. When it goes up, volatility spikes. It's the opposite. Okay. Had a lot of people today. I talked for a little bit longer than I thought I was going to, but hopefully people found value. We do these streams a lot, so if you enjoyed this, especially the Q&A section, then come back. I'll just show you a few of the topics, just for all those people that are kind of new here. Just scrolling through some of the topics that we do. We going a little back end of my YouTube channel here. So, I mean, just scrolling through, we talked about AMC. We talk about volatility metrics quite a bit. We have a lot of private live streams. Those are only for the community. You don't have to pay me money to benefit from my work. There's 1,000 articles and videos, but we do have a community that's paid as well, and we do a lot of private stuff. UVXY, we talk about a lot. VXX, of course. ARC Innovation, that was a fun live stream. Got a little bit of hate for that one, but it is what it is. XIV and TVIX, we're seeing a revival here. We're kind of just waiting on these new SVIX and UVIXs to launch. So could be any day, could be never. Bunch of private stuff there. I actually did one emergency in a coffee shop, so that was fun. But contango, backwardation, we talk a lot about these things. So anybody who's following today, if you enjoyed it, follow me on Twitter. You'll get notified next time. I don't know if you know YouTube. Most people know this, but on YouTube, if you want to subscribe, you do have to click that stupid little bell. Otherwise, it's not going to tell you when new videos pop up. You have to actually click that bell, and then you'll be notified. But yeah, this is what I do. We'll be back next week. So thanks, everybody, for watching, and hopefully you all make some money by controlling your risk. Don't make money by chasing and speculating. Make money by controlling risk. So thanks for watching.